All right, let's talk about the biotech market heading into 2026 because it's presenting a really fascinating paradox. On one hand, you have this incredible explosion of scientific innovation, but on the other, the sector's facing this major valuation gap. Why? Well, a whole lot of capital is just flooding into another huge technology, AI. So the big question for us is, where's the real opportunity for outperformance, for alpha actually hiding?
Okay, so here's our game plan. We're going to start by unpacking that weird market anomaly, then dig into the specialist playbook for how to actually take advantage of it. We'll stress test the big China and AI factors, look at a pretty interesting quirk in the private markets, and then wrap it all up with a solid framework you can use to spot these opportunities.
So first up, let's get to the heart of the problem. There's been this massive shift of capital, and it's creating a really clear inefficiency in the market.
And the scale of this capital shift, it's just staggering. I mean, look at this number, 65%. That's how much of all U.S. venture capital deal value AI snapped up in 2025. Think about that. It's like a fire hose of money, and it's created this intense competition for funds, basically putting AI in a head-to-head battle with the life sciences for every single dollar.
Well, this massive capital flight away from biotech and health tech has created something Bessemer Venture Partners calls a trust gap. And what that means is you're seeing a really significant valuation discount in a sector that's still growing like crazy. In fact, some of these firms are trading for less than the cash they have on their balance sheets. It's wild.
And this chart just lays that disconnect out bare. Get this, even with twice the revenue growth and higher free cash flow margins, high-growth health tech and biotech stocks are trading at a 10 to 20% discount compared to cloud software companies. I mean, that's a classic behavioral inefficiency, a market anomaly that specialists are just perfectly positioned to exploit.
Okay, so let's shift gears and talk about the solution. How do specialists look at this same information and come to a completely different conclusion than the rest of the market?
So at its core, this whole inefficiency really boils down to how different investors think about risk. You have your generalists who get trapped in what we call an inside view. They see a biotech company as just one big binary lottery ticket. It either wins big on a clinical trial or it's a total bust. But specialists, they see things completely differently. They use a sum-of-the-parts approach. They don't see one lottery ticket. They see a whole bag of options, a portfolio of different assets that they can actually value one by one using probabilities.
And this is that bag of options framework. It's a much more quantitative way to look at things, moving way beyond those simple stories. The company isn't just one big bet. No, it's a collection of separate assets. Each drug program it has is like a call option, and the strike price for that option is simply the cost of getting it through the next phase of clinical trials.
This table does a great job of contrasting the two mindsets. So, a phase 2 trial fails. To a generalist, the story's broken. It's a total loss, time to sell. To a specialist, it's just a trigger to recalculate the value of the remaining options. A company announces an AI partnership. The generalist gets caught up in the hype. The specialist starts auditing the numbers. And relying on clinical data from China, that's not just a cost saver. A specialist knows it comes with a pretty hefty geopolitical tax.
Okay, so let's actually apply this framework to one of the trickiest variables out there right now, this so-called advantage of running clinical trials in China.
Now, on the surface, this clinical arbitrage looks pretty darn compelling. By 2023, China was handling almost 40% of all global clinical research. Why? Because timelines are up to 70% faster, you get huge cost savings, and you can recruit patients way quicker. It seems like a total no-brainer. But if you red team this, you uncover all these underpriced risks. In mid-2025, the FDA suddenly put a halt to trials that were sending U.S. patient samples to China. Then you've got the Biosecure Act, which is forcing a slow 8-year breakup with certain Chinese biotech contractors. It's creating a serious long-term choke point.
And on top of all that, you've got the FDA's 20% rule. This is a big one. It basically says, no matter where else you run your trials, at least 20% of the testing has to be done in the U.S. to get approval. This isn't just a guideline, it's a hard rule that caught even massive companies like Roche completely off guard, and it shows you it's a real and very costly hurdle.
All right, next up, let's apply that same tough, rigorous audit to the AI narrative itself. The very thing that's pulling all this capital away from biotech to begin with.
So the big question, the million-dollar question, is whether AI can finally reverse Eroom's law. That's Moore's law spelled backwards, and it's this grim reality that drug discovery has just gotten slower and more expensive over time.
So, is AI a genuine productivity booster, or is it just another arms race that's going to destroy margins?
Well, the evidence actually points to a real shift. These new-age digital CROs, contract research organizations, are really tackling the big three problems in R&D. They're crushing timelines from years down to months, they're swapping out expensive lab work for computer models, and they're using AI to pick better patients for trials, which could put a serious dent in that staggering 90% failure rate for new drugs.
So for a specialist, the key is to really audit this health AI X factor. And you do that by looking at cold, hard metrics, like the annual recurring revenue per employee you see here. This is the jump that matters. These AI-native supernovas, pulling in over $500,000 per employee, that represents a real, tangible step change in productivity. It's how you separate the hype from reality.
Okay, now let's move on to a much more sophisticated edge. This is all about understanding the deep structural differences between how public and private biotech companies get valued.
And this brings us to this really fascinating idea called volatility laundering. Cliff Asness has talked about this too. Here's the deal. Because private companies aren't priced every single day, their reported returns look artificially smooth. It's a way of, well, laundering the risk, hiding the real underlying volatility from investors. And this whole practice creates this illusion, this mirage of low risk. But the reality, which this chart shows pretty clearly, is that private capital fundraising has been dropping steadily since 2021. The private market is actually really capital constrained right now, and that's a truth that often gets hidden by those smoothed-out valuations. And right here, this is where the specialist's edge lies. They can use the transparent data from the public markets, things like clinical trial results, as a kind of truth serum. A public company's success or failure for a certain type of drug sends a real-time price signal for every private company working on something similar. This lets a savvy investor get way out in front of the private market's eventual and much slower revaluation. Okay, so let's tie all of this together. Let's build a final, actionable framework for how to approach the market in 2026.
The real ultimate edge is becoming what we call an ambidextrous investor. What does that mean? It means you have to master the exciting scientific story, understand the potential, but at the same time, you have to stay totally anchored to the cold, hard data, like the fact that 90% of drugs fail. It's about being able to use a value lens for those beaten-down biotechs, but also a growth lens for the AI innovators, all while using that bag of options model to analytically price the risk.
And that really brings us to the core takeaway for 2026. In a market that is just absolutely mesmerized by the AI story, the greatest alpha, the biggest outperformance, it's probably not going to come from the science itself. It's going to come from the disciplined, probabilistic pricing of that science. In this kind of environment, biotech is not a lottery ticket. It's a quantifiable frontier for generating real alpha.